5 minutes.
Yeah, it takes a minute. It looks like this broadcast was deleted on Facebook. Try a new broadcaster, go live. I'll just put go live. Lainey, help me on this. Hi, everybody. This is Mark Mopp, and I'm wanting to welcome all of you. Don't worry about it if it doesn't. Yeah, this is broadcasting over a lot of channels, so I had one that wasn't there. So I want to welcome everybody. Start showing some of these comments as you guys come on. I'll let you do this, Lainey, as they come on. I got my granddaughter helping me here with the screen. So my name's Mark Mappin, and I run a meetup that's a live meetup. And I have a partner. His name's Eddie Williams. He's on the call with us tonight. And during the winter months, we don't meet live. So we do events like we're doing tonight. I'm going to give it enough time for a few people to get on here. So we also have a YouTube channel. It's I'm putting that on right now. You'll see it there. It's the YouTube, and then it's got all my personal links too. So I think you gotta click that to show it. There we go. And I'm trying to think what else. So on our YouTube channel, we record all these meetings we have, so you can go on the YouTube and watch them after the event. So you don't have to worry about writing stuff down all the time. So I think I'd like to, Frank, you're on with us. So our guest is Frank Alcini. And I want to welcome you for being here. You can't find a better CPA than Frank, and incredibly knowledgeable, especially in the real estate arena. Well, actually, all the arenas I've talked to him about. And I've used Frank with my, I run a national charity where you donate real estate, and he's answered a ton of questions for me. So Frank, welcome.
Thank you for having me.
Yeah. So.
And everybody that's on, any questions that you have that you hope we can touch on tonight, feel free to send those into the comments section, and we'll try to answer everybody's questions.
Absolutely. So you can feel free to start putting your questions in. And if you'll notice, Frank's contact information's there. So if you want to text him, his phone number's there. You can schedule a free consultation with you if you've got questions or want to.
Yes, one of the things tonight, everything we'll go over will be general in nature. Quite often, after you leave this, how does that apply to you? And everyone's situation's different. But if someone has more questions, definitely, if you text 20 to that number, you can schedule a time. There's a 2-step process, but you can schedule a time and we could talk further about your specific situation. But encourage everyone who's looking for more information, do that. It's a great way to reach out to me. And you can check me out on the different social platforms at REIA CPA.
That's great. Did you just want to open it up for questions, or did you want to wait for a few more people, or will you entertain a question?
Yeah, or I mean, if you have a question, I mean, we can get started whenever.
I have my own greedy questions. So
okay,
a lot of times investors have properties that are complete blowouts or absolutely in really tough shape, and I run a national charity that accepts real estate donations, and we have gotten some good donations. So I don't want to make it sound like they're not always good, but the majority of people are giving us a property that they don't want. You know, it's tax delinquent and that, and we're willing to step in and get that property sold. So what is there tax advantage besides getting rid of a problem property? What would be a tax advantage to somebody donating a property?
Generally at a high level, donating a property is going to generally qualify for the fair market value of the property. Maybe a property that someone inherited, um, could be a property that they just don't want anymore for whatever reason, and then be able to donate it to a charity such as yours and really be able to ultimately turn what they don't want into a better need for funds for your charity to be able to help kids and really drive successful lives. But from a tax standpoint, a lot of times there could be certain tax implications depending on if there's debt or depreciation or delinquent taxes. You may have a property at a certain fair market value with a number of other underlying attributes to it, and donating it is definitely an option to explore because you may be able to get a fair market value contribution while also being relieved of that unnecessary headache that you have. So it's really a great opportunity. I encourage everyone, if you have a property, definitely reach out to Mark, and you could be able to discuss it further. Then from a tax standpoint, it might be a great opportunity to rid yourself of that unwanted property.
Yeah. Thanks. I appreciate that. I see Eddie put in a question. What is a cost segregation?
Okay. So cost segregation is talked about a lot, and a lot of us think about, let's just say I went out and bought a 60 unit multifamily apartment complex. I'm going to pay X for the land and real estate, and from there the IRS has dictated to us that on a straight purchase I'm going to allocate some balance to the land because obviously there's land there. Then the rest of it's going to be treated as residential rental properties. So let's take for instance that I bought a $3 million property. Land is worth $300,000 and or 250,000, and that the building value is worth 2.75, which coincidentally is depreciated over 27 and a half years. So me purchasing that apartment complex deal for $3 million, my first year, I'm generally going to be entitled to $100,000 of depreciation because 27 and a half years, or 2,750,000 divided by 27 and a half years is going to come out to 100,000. My example of multifamily is actually a great opportunity because you've truly bought a lot of different improvements, building improvements, site improvements, land improvements, machinery and equipment, grounds equipment, appliances. And something such as that is really going to be able to identify faster items. And if you follow the elements of the IRS cost segregation audit technique guide, you'll be able to identify those specific items that are included in that $3 million that for that multifamily. So for instance, let's just say 10 or a third of that was eligible for 5, 7, and 15-year property for faster depreciation. So now I'd allocate $1 million to that other stuff. I'd still have to identify what that is, whether it's appliances, furniture, and fixtures. But more recently, up until the end of 2022, those items qualified for 100% bonus depreciation. So as an investor, if I bought that $3 million deal, I could potentially qualify for about 100,000 or $1 million of depreciation my first year. Every deal is different, but could potentially free up a lot of that depreciation. My depreciable basis in my real estate would obviously be reduced because I'm allocating more to faster items, but I'm going to get that upfront depreciation that'll really help in a tax position. And it really depends on the size of the properties, whether it makes sense. I see another cost or question that came in from Joe. What's the average cost for cost segregation? it really ranges on the level of scale of the property, the location, but generally that sweet spot's about 400,000 and above worth exploring. Whether that property is a great candidate for cost segregation, because what I'm seeing out there, a real cost segregation needs to be done by a financial person with an engineering side. I don't do the cost segregation. I do have companies that I can refer that to, but generally that's going to start out about 3,500 to 4,000 for them to do a full-blown study. And there's certain 11 target elements that the IRS would look for. So in a cost segregation study, me as your tax preparer to rely on that information. My job is also to make sure that you're covered and that report covers that level of information. So I always encourage clients, give me a call, let's talk it out, and you can explore. There's multiple companies out there that do a great job, but it's definitely an opportunity. And that's going to apply a lot of times more on smaller deals. I get this question asked where I have a client that's doing maybe more of a renovation. In that case, we might be able to do more of just a cost identification when they're building that out, still qualify for some faster depreciation, but it's because they're acting as the contractor on those items and able to identify what it is, whether it's the appliances. So at the end of the year, when I'm working on the tax work, I can identify what those items are and qualify that. So throughout the year, I work with my clients on certain renovations, at least in guiding them on the detail to make tax time a little bit easier, and that we can get a better scenario rather than going back. So one of the things I do with clients is work with them throughout the year with calls and emails and any questions they have. I usually tell clients, if you're buying, selling, renovating, contact me. It's easier to get in touch and make sure we're on the right page throughout the year and position you for the best time at the end of the year. Another question came in, if I only work with real estate investors. I don't 100% work with real estate investors, but I'd say my largest focus is real estate investors, construction contractors, and probably 95% of my clients are in one aspect of real estate. My background is I've been working with real estate investors and construction industries for almost 20 years, concentrated. And I think those of you that are real estate investors have all come to this for a certain reason. And one of the things I identified, it was really the fastest, funnest way to grow wealth and opportunities. So started to notice a trend as I started to work with real estate investors. So that's so I guess overall I pretty much do work with real estate investors mainly.
I have my grandkids that work for me actually in my business, where they do things like my grandson. I'm in the internet business. I have probably 40 computers in my house. He does repairs on them. My granddaughter does work for me. Are there any advantages when they're grandkids in some way you could pay them, or where you don't have to take the taxes out, or is it automatically given that you take tax out?
So,
Family.
So that's a great question. It's really going to depend on what type of entity you are. So generally, if you're a Schedule C filer, sole proprietor, single member LLC that files on your Schedule C, when you pay your kids, generally they're not going to be subject to the self-employment side of things. And then if they are paid enough to qualify under the standard deduction, that the idea is that, let's say I pay my kids $5,000 for working on computers and doing different things and helping me on my real estate business. I'm going to be able to take that tax deduction, and then the kids are going to effectively have a situation that they fall under the standard deduction. So those dollars are going to effectively not be taxable. and not subject to self-employment. Now, if you're an S corporation, that's a little different. You may have to pay them payroll or put them on a 1099 or something where they may be subject to the self-employment, which is the equivalent of the Social Security and Medicare side of things. But if they're still under those limits, they may effectively not pay income tax. Again, I caution people on that. If those of you that have young 2 and 3 year old kids, it's really tough to argue that they were working for $12,000 a year. Mark mentioned his granddaughter. That's a great example. I see. I mean, she's helping him this evening set things up. As he said, working on the computers. Those are all justifiable things in those situations. So absolutely paying them. So Mark, I think this Friday you probably have a check due.
Okay, thank you. So you have another question there from Joe.
Okay. So again, on a single family home, it's really going to be a case by case. It really is going to be a situation that, again, maybe reach out to me. We could discuss it a little further on a single family home, and I'll always reach out to the company because there's different types of single family homes. If it was a situation, those of you that are more on the short-term rental side of things and could potentially buy an outfitted Airbnb home, you're going to generally, let's say, pay X for a property. A lot of times with my clients, I tell them, try to identify the equipment when, let's say, Mark is selling me his fully furnished and renovated Airbnb for X amount of dollars. Well, rather than paying him X for the real estate, we really should be identifying furniture and fixtures. If there's any equipment, let's say it's a house on the lake and it's got some equipment, out back, for different boats and for the furniture. Those are still things that you may not have to have a formal cost segregation done, but based on the sale price, that was based on the sale documents, we'll still have enough evidence to be able to properly file the tax return and take some of the benefits of accelerated depreciation. So that's a perfect example. Throughout the year, I have clients reach out to me and be able to see if there's anything before they purchase a property that needs to be done, more focused on what's going to be the best tax advantage for them. Hope that helps. And
got another question for Eddie. From Eddie.
Yes. So Eddie's asking if you have minor children working for you, setting up an IRA fund for them and use a portion of that salary that you pay them. Yes, absolutely. That's a great way so for instance, let's say I have a child that's working for me. I want to put some money away for them and they're working, and then I pay them $4,000. They can then convert that into an IRA contribution based off of their earned income. So that's a great way that they can start putting away money into an IRA, and it can be a number of types of IRAs depending on what it is, but it's definitely a great resource opportunity with kids and to help them start building that future.
So when I jumped into the real estate game, my wife and I went to a class on how to buy rental property, and we were just jumped right in. So like, if you're a brand new investor just getting into real estate investing, say for rental property, can you give us some of the big mistakes that are made, or give us a guideline of the basics, because they don't have any knowledge of what they would need for taxes?
Yeah. So, I mean, let's just say I'm a new investor. I go buy rental property, and it's not rented. The biggest thing is really to get an accounting of everything. So I always tell people, you really need to track first off your expenses from when you were looking at that property, when you bought the property, when you bought the appliances, and that's really stepping way back. And those of you that are using personal funds, at least identifying which of your personal funds in your personal bank account that qualifies for. Now that I close on that property, if I'm going to operate it as a business or just as a sole proprietor, I always encourage clients to get a separate bank account where my tenant is going to either give me rent checks or deposit into my business account. And whether I'm using the term business account, meaning my separate personal account, I may have Frank's personal checking and then now Frank's rental checking if I'm just operating as a sole proprietor. But what that's going to do is help me track my income and then all my appropriate expenses. The biggest thing I see is people paying with different bank accounts, different credit cards, not tracking things. Because all of your expenses related to that property, we're going to want to be able to capture and deduct on that. And then the biggest thing is all of your rental payments, making sure that we report all that income on there. So, and then when, let's say you're going to go make a large purchase such as appliances, I always tell clients, transfer that money, a few $1,000s from your personal into your business or your separate account so that you can at least easily track where that's coming from, because I may put $3,000 in there and that may really be spent on a trip to the appliance store, trip to Home Depot, and the different home improvement stores with the miscellaneous fixes. And it'll be much easier to track and not what the IRS calls commingled with all your personal funds and activities. And generally, the IRS takes the position if you don't have books and records, all deposits are income and expenses are personal until proved otherwise. So that's from a rental standpoint. One of the first mistakes, there's a lot of systems out there. A lot of times I even get people take advantage of the number below and set a time with me to kind of walk through what they're doing. I have clients that work in different accounting systems. Some do a fantastic job in Excel. So it's also what we're familiar with. I can tell you to get an accounting system. If you're a wizard in Excel, you might do a great job and be able to track everything there. So really mapping out what's going to work best for you and what's going to also something that you're going to use and keep up to date. So that's, and whether that's, Mark mentioned a real estate rental business, but if you're in the business of flipping houses or just starting, if you're a real estate agent, really separating that business from personal funds is the first key item that I really see. Number of other things, but that's really the first step to start to get things. Did that kind of answer your question, Mark?
It did. And then when we went from rentals, we went into find, fix, and flip. That absolutely changed my tax situation.
Yeah.
Could you spend a second on that? Because I was pretty naive to that when I did it, and I had some surprises. So.
Yeah, and see with that, let's say you have your rental business. Now I'm looking at a different activity such as fix and flip. That would really be something to, first off, I'd say talk with your attorney or CPA, map out what's going to be best for you, because everybody's situation is different. It may consist of setting up a different entity to operate from, maybe setting up a different bank account, at least get in. Let's just say I'm operating as a sole proprietor in these situations. If I was going to undertake a large fix and flip or a couple, I'd probably want to keep those funds separate from my rental activity, because at the end of the year, it would really help me with bank accounts. I have seen people set up separate bank accounts for every property. I think that's way too much and too cumbersome. It's easy if you have 5 rent deposits every month, I can identify what they are. But as you're by activity, a business structure or separate business purpose will definitely make sense and really help you in the future. Plus, to help identify if I'm constantly putting money into my rental business, but my flips, are growing, now maybe I should focus on something else. So it'll help you identify where your cash flow is going and drive from there. Then, as you mentioned, truly fix and flips are more of an ordinary income nature, so they're taxed a little bit differently. So that's why I always encourage planning with clients. Are you fixing and flipping? Was that a rental that you improved and happened to sell? I might own, let's say, 5 rentals on the same street. I buy the 6th house, and then I get it nice and rent ready. And then Mark knocks on my door and wants to buy it. That to me would probably be a different situation, more of a shorter long-term investment sale versus a fix and flip. And it would really depend on what you were doing. So that's a perfect situation that I always encourage clients: when you're buying that 6th property, get on the phone. Let's talk about it. Are you improving it to get ready for rent? But the way the market's been, I may sell it. Or is it truly, I'm going to just go in, treat it as a business, fix and flip it, and sell it? Failure to plan's kind of planning to fail. So did that answer your question, Mark?
It just described my life.
Oh.
but now I'm on the straight and narrow. But I can't say enough how important what you just described, and talking to somebody and getting advice to set it up properly going in is key. I won't do anything unless I do that now. So
and I will say that there is a lot of information out on the internet, whether it's the different forums, YouTube, the different social platforms, whatever. A lot of it's great information, but I always encourage clients, talk to me or other people, talk to your advisor, just because what situation may work for Mark may be a little bit different for me. Eddie's got a question waiting, may be a little bit different for Eddie. We all may be doing something similar, but it may fit in our little tax structure a little bit different, or our financial structure. So it's kind of a great roadmap, but now let's drill down to what route we're going to take, So, I mean, I know if I'm going to go from here to Florida, I'm in Michigan, for those of you that are not. If I'm going to go from Michigan to Florida, I'm going to go south, but Mark, Eddie, and myself all take different routes based on where we want to stop, what we want to see, but we'll still all end up in the same place, and it's what's going to fit all of us. So think of your financial and tax picture that same way. And then I see a question here from Eddie. If your income's strictly derived from real estate, is there any type of retirement plan, IRA, 401k, etc., that you can set up yourself? So a lot of that's really going to drive off of what type of real estate you're doing. I mean, are you active? Are you an agent, a flipper? I think there's probably some wholesalers on the call today. Are you just strictly an investor? So there are different opportunities, but it'll really be driven off of what you're doing, what your profit is, and then what type of entity you are. So, and what type of plan there is. There is different solo plans, self-directed plans, but definitely something to look at. And a lot of that is based off of your reportable taxable income. So, for instance, there's solo 401ks that you can really put away a lot of money in situations, but you also have to have the taxable income to justify that contribution. So, because they're all off of different percentages or limits. But yeah, definitely, if you're in real estate, you can still fund different plans, and it's something to definitely look at and explore.
Yeah, if anybody's got a question, please type it into the chat. There's no dumb questions.
Okay. Did you have any more questions, Mark? Or
Um, what would be more around what you've seen in the market? Like Eddie's got popped another one up. I'll wait and ask mine afterwards.
Okay. So one of the biggest questions, LLCs versus S corporations, and that's really where we were talking for those of you that are on the call about there and on the newer side of things, how you're structured. So really it's going to depend on what you're doing. An LLC and an S corporation at a high level is both of those entities at a high level, the items of income and expense flow through to the owners and are taxed at their individual level. And I've been told by more just regular people, well, aren't they the same? They both flow through. I get a K1 with both of them. And LLC is really a legal structure. And those of you that are in different states, it's going to be governed by your particular state, whether the state you're organized in or the state that you're doing business in. And then an LLC can be taxed and now we're talking the tax designation as a single member LLC, which would be a sole proprietor. As a partnership, let's say Mark and I both own an LLC, and we would file a partnership return, or we could elect corporate or S corporation status with that LLC. So there is some legal items with it, and also with the tax structure. Now, an S corporation is its own separate corporation that was established that then takes one step further and makes a S election with the IRS. At the time when clients are setting up this structure and forming their corporation, I always discuss with them, because with the S corporation, today is February 20th, and let's say I set up an or a new corporation on March 1st. I'm going to have 2.5 months from that date to make that S election and get that filed with the IRS to be timely filed. There is some relief for late election, but if we know we want to do that, I try to get that done right away for clients. But that would file its own tax return. Now, if I'm the only owner of that S corporation, I still file a separate tax return. If Mark and I are both owners, we're both going to file, or the company is going to file a corporate return and then provide both of us with K1s with our respective ownership. Now, as corporations on a distribution level, let's say Mark and I are both partners in a company. We both put in $50,000, and then Mark takes out 5,000, I take out 10,000. With an S corporation, we generally can't do that. Distributions have to be in the same proportion of the ownership. So if, for instance, Mark and I are both 50-50 and he takes out 5,000, I can only take out 5,000, or if I take out 10, he needs to get that. So LLCs have a little bit more flexibility when they're taxed as sole proprietors or partnerships. As soon as they elect S corporation status, they fall under those distribution rules. But with an LLC, Mark and I could have a real estate partnership that we each put $50,000 in. He takes out 5,000, I take out 10,000, and all that does, and we're still 50-50 because our operating agreement allows that. But then all that would do is adjust our capital. Mark would have capital of 45,000 because 50,000 less his 5,000 distribution. I would have a $40,000 capital of my 50,000 less my 10. Where in that S corporation example, it would have to be equal, and we might actually have equal equity in that company, but one of us might owe the other, and you run into different liability. Then they're both taxed differently for tax purposes. So, for instance, LLC income is generally going to be subject to self-employment tax, while S corporation income is not, but you still do have to watch the reasonable compensation guidelines. So, for instance, if Mark and I were doing some type of service business, selling something, and some type of regular ordinary business through an LLC, it would all be subject to self-employment. If it was our income on the S corporation would not be, but we also still have to take what's called a reasonable compensation if we're both actively working in that business. Now, if it's an S corporation that we own and we have a manager and we're sitting on the beach not active, we don't have to take officers' compensation if we're truly not active in that. But that same income coming from an LLC, whether we're sitting on a beach, would still be subject to self-employment. So it really depends on what avenue of real estate you're in, what entity to use. They are very similar, but very much different. My personal opinion in certain situations is more of the buy and hold type real estate's going to be in an LLC taxed as a partnership due to some of the refinancing opportunities with that, and more of the ordinary income type entities are going to be more structured with an S corporation. So that's kind of it. But then again, does that fit for you? I don't know. It would have to make sure that it fits into your tax roadmap. So hope that helps, Eddie. I see a question here from April. I'm a new investor. Initially, I'll keep up with the documents. Which financial tools do you suggest? For example, QuickBooks. There are a lot of programs out there. Really depends on what you're doing, what you're comfortable with. QuickBooks is the main accounting program. And then now on the property management side, those of you that are landlords, there's a lot of great, more rental focused property management softwares. QuickBooks isn't as strong in that. Now on the lower cost side, there's a program called Wave Accounting, or I think it's Wave Apps, that for some of you that have multiple entities that without much activity, it's really a great resource. You can set up multiple companies, bring in the bank information, do your accounting. And I always caution clients, don't try to account for multiple entities into one QuickBooks or whatever subscription unless it's a large enterprise program. But more on the property management side, I'm seeing more people starting to use Stessa is a great program. It's free. It's got different add-ons. Then there's a number of other lower level property management systems that you're able to use, whether it's for tenant applications, background checks that they have built in. So again, I'd explore those free options, especially if you're a new investor. Wave more on the basic accounting, and then there's Stessa on the rental property side. And then it goes back to what you're comfortable with and what you're going to keep up on, because you can get the best system, but if you don't have the team or yourself that are going to stay up to date on it, it's not going to be any more powerful than a blank notebook. So hope that helps.
Then if anybody's got like more detailed questions or wants to have a conference with you, I'll just say it again. The information shown on the screen now is how they could schedule a consultation with you, correct?
Yes.
Yeah.
Yes, you can text 20 to 248-461-3120. You'll receive a response back. Not sure that I think it only goes out between 8 a.m. and the response back 8 a.m. and I think 10 p.m. But you'll get a response back with a link to my scheduler. There's a form you can fill out and schedule a time, and we could talk further. And then you can find me on all the different social platforms at REITAX CPA, REITAX CPA, and you can find me on those, and definitely reach out with anybody who has more detailed questions or specific. And I see a question asking what areas. I work with investors all over the country, and it would really depend. I work with a lot of clients virtually and remotely, and if it's something that you wanted to meet in person and you're in California and I am located in Michigan, that's going to be rather difficult, but I do work with people all over that have investment properties, whether it's in their home state or my home state, or I have clients that have properties out of the state that are home to Michigan, such as myself, that have properties out of the state, but schedule a call and we could always talk further.
That's great.
Any other questions come to mind, Mark?
Not off the top of my head.
Okay. But yeah, and then I think one of the things that was brought up earlier as far as cost segregation, that's a great front end tool. And one of the great exit strategies that kind of goes hand in hand with that is a 1031 exchange, which for instance, let's say I have a property, I bought it for $500,000. I'm going to sell it for 750 and I've depreciated it. I'm going to have a pretty substantial gain on that property. And quite often I get from clients, should I sell this property? Should I pass on it because of taxes? Well, if you're a real estate investor and you're going to sell one property and you're looking to get what's called like kind property, and to us, like kind, or to us, a single family home isn't really anything like a commercial building, but within the tax code, rental real estate and investment real estate is like kind property. So I may have 5 single family homes in Michigan that I want to effectively trade for a multifamily deal down in Florida. That would qualify. There are certain requirements with a like kind exchange, a 1031 exchange it's called, because that's the tax code internal revenue section that it references. But what it says is I can effectively sell those single families in my example, place that money with a qualified intermediary, and then within 45 days, I can identify my new property, and then I have 180 days to close. So those of you that are active real estate investors are probably always looking at deals. So when you're selling, you probably already have a few deals in the works, and it might be an opportunity. Mark comes to me, gives me a contract today with my property that we're closing in 30 days. I may effectively have 65 days or 75 days to start looking for property, because we signed the contract today. We don't close for 30 days. And then I've got 45 days from that sale date to identify. So if I get to work, I could probably find a deal that I could reinvest my money and defer that. So it's definitely something to explore based on your individual tax rate, what the tax exposure is going to be, whether it's going to be a deal that's already leveraged and you may not be cash rich after the deal. I have had situations, clients have large gains but don't have the cash to pay the taxes and roll it into another deal to just defer that. So that's a great exit strategy, as that cost segregation is a great entrance strategy after you've entered the deal. Anything I could add to that you can think of, Mark, on the 1031?
No, I got to be honest, I've never done one. So
okay,
yeah.
Okay, that's just a question I get quite often, and it's just an excellent strategy if you're selling a deal and getting into another one. So when buying materials to update buy and holds, how are those written off? So it's really going to depend on what of what nature is it? Is it materials for general repairs? So generally those are going to be written off as repairs and supplies, such as the toilet breaks or the tenant kicks over the toilet, snaps it, destroys the bathtub, they move out. I have to repair those items. Those are generally going to be deductible expenses on that property. Now, if it's a property that I bought that was a buy and hold, had no bathroom in it, and now I'm adding it, it may be something that's going to have to be capitalized and depreciated. So a lot of times it would depend on the nature, but if it's an existing buy and hold and it's not improving the useful life, generally that's going to be an immediate expense. It may be fall under cleaning and maintenance, under materials, repairs and maintenance, or supplies. So it's kind of a broad question, but if I'm putting a renovation or an addition onto a property, because I'm going to turn a 2-bedroom into a 3-bedroom, that's probably going to be something that's going to have to be capitalized and depreciated. But if I'm going in between tenants and repainting, changing the carpet because it's been destroyed, and changing a lot of the hardware that's been broken, those are going to be more of the repairs and maintenance nature that are going to be deductible on the tax return. So generally, every item spent in relation to your deal is going to go somewhere. It's just how is it treated and what did it do? So hope that answers that for you, Joe.
So if I'm a real estate investor and I'm working from home, what are there things like I can do, like the car that I'm driving? Can I put that into the business? Can I have an office at home that I'm able to use? Like if I'm using one of my rooms for an office, what are some advantages that I could have with some of my expenses by putting them in the business? If they're
So
yeah.
So the home office is some years back they came out with the simplified method. It's just like with vehicles. It's something that's going to be more case by case, but the IRS came out with the simplified method. So those of you, for instance, your automobile, a company can buy the vehicle, pay all the expenses, depreciate it, pay for the repairs, the insurance. Think of a construction company that has some service vans and those vans are being used. Now, in more smaller businesses, automobiles, I always caution clients, are one of the things the IRS looks at because um, as a small business, does the company have 2 or 3 vehicles? What are they doing? Or is there a business purpose? So alternatively, there is the mileage deduction. So this year it's gone up to 65.5 cents. So for every business mile I drive, I can take that deduction. So a lot of times, depending on what type of vehicle you're driving, mileage may make more sense as opposed to the actual costs. I always look at that, where if, let's say, I buy just a regular 1-year-old or lower mid-level sedan for business, and I take the mileage deduction, when I sell that, I don't have to have any recapture. There's no gain on my sale. And depending on, assuming it's fuel efficient, insurance, and I drive a lot of miles, it may be cheaper, or it may be more beneficial for the taxpayer to take the mileage deduction. Now, take the same position of that service van that a construction company has, that they're not going out to dinner with the family in. It really is that business vehicle that would qualify for depreciation of the vehicle. Insurance, repairs, fuel, all of that would be deductible business expenses while you have it. But let's say I own that for 5 years. Now I've depreciated it down to zero. And then when I sell that vehicle, there is potentially, let's say I sell that used vehicle with 150,000 miles to mark for $15,000. I could potentially have a gain at the sale on that vehicle. So it's something, when you're looking at over that long period of time what you're doing. But with that, are you going to have a recapture? Where my example of taking the mileage deduction, there is going to be no recapture when I sell that. And depending on how many miles I drive, it might even be more beneficial. So it's something to look at case by case and vehicle by vehicle. But also with a vehicle that if you're working from home and it's your only vehicle, the IRS is going to want to see business versus personal, and then allocate a percentage of that. So let's say I have $10,000 a year in costs related to that vehicle, but I'm only using it 40% for business, they're going to offset some of that for my personal use. So the vehicle, then with the home office, they have the simplified method that's going to be kept, but it gives you a maximum of square footage, and it's a maximum deduction of $1,500 a year on a profitable business, where alternatively, I could take, let's say I occupy 15% of my home, allocate 15% of those costs, but they heavily scrutinize those. And most of us don't have a home office that doesn't also serve as a closet, a bookshelf, room that we store extra personal items in. And any of those things by nature would disqualify that. So it's something to be very careful about. It may be where you do your ironing and you have an ironing board set up. I'm not sure if anybody does any ironing these days, but that is something that would totally disqualify that as a home office. Now, and truly, in all my years, I've probably only ever had 2 clients that I could arguably say had 100% bulletproof home office that was going to qualify 100% with any IRS scrutiny, because I think in our homes we live in them. So it's just something to discuss with your advisor, but just be aware sometimes there's some caution if we're not taking that simplified and method. But those are both great opportunities for those of you that are running businesses out of your homes.
Got a few more questions coming in. Another one from Eddie.
Okay. So relating to new real estate clients, some of the more commonly missed deductions I see, it'll really depend. I've had situations that um, actually looked at somebody's return recently that they were calculating their own depreciation, or they were using their own system to do their taxes, and um, depreciation was actually not calculated on a few rental properties. I saw someone that was going to a different tax preparer, and didn't even know this. Their tax preparer was using 31-year depreciation, and I called him up and said, "What's this number?" And he kind of yelled at me and said, "That's the number." I did some research because I couldn't figure out where he got 31 years from. That code changed. I've come to find out, I think in 1991, they went from 31 to 39 years. And that was news to me. I know may look older, but I haven't been practicing back to then. But it just kind of told me if he wasn't updated on the depreciation, what else was he doing with his clients? But the biggest thing I think is more newer clients with really getting those disciplines in place, such as accounting, tracking your records, and those of you that have multiple entities, having proper title. More oftentimes than not, someone has 3 or 4 LLCs. Settlement statements when they're purchasing are in all the different LLCs, but they're being accounted for somewhere else or reported. So really getting that organizational chart that we're trying to achieve to reflect what's actually happening. So I do see that often, whether it's title issues, and not necessarily a title issue, but reported on the wrong return because, well, I act that it comes out of company A, but it was really owned by company B. And just really, I think the more poor planning, I guess, would be some of the other big items. So I see another question. W-2 employee looking to buy and hold, 20 hours per week required to be an active investor. Certain activities that some people might mistakenly categorize as something that counts towards that. It's really going to depend on if you're on your buy and hold, are you actively working on those properties? there, collecting rent, doing the accounting, doing the maintenance of the records. It's going to be different activities related to that. And 20 hours per week is actually going to be about 1,000 hours. So I'm not exactly sure where the, yeah, 20 hours times 52. I mean, that's going to be about 1,000 hours. Not exactly sure where that 20 hours is coming from, whether you're referencing the 500 hours requirement or maybe confusing with the 750 for real estate professional. But it's going to be activities related to your business. But yeah, I'm not sure where she's referencing 20 hours per week. But it may be with the 750 related to real estate professional. That's a question I get a lot. So for instance, let's say Judy has a W-2 and is actively engaged in real estate, has some rental losses, and wants to offset her W-2 with that. Real estate professional situation is explored a lot, but it needs to be 750 hours plus your greatest activity. So, okay, another question. So, for instance, let's say I'm in real estate and I do a lot of things. I might do 1,200 hours a year related to my rentals. I own a large portfolio, but I also have a W-2. I'm not going to qualify because the first test is 750 hours per activity. Then there's a second step that you can group all activities together. So now all your activities may put you over that 750, but it has to be your greatest activity. So if I'm a part-time, I work 250 hours or I work 800 hours a year doing something, part-time, my requirement to be real estate professional would be greater than 800 because it has to be my greatest activity. By nature of having a W-2, most people won't qualify because it'll be really tough to prove that you work 2 full-time jobs, because you'll have to have your full-time job and then another greater than 2,080 hours in real estate, and that'd have to be a really large portfolio. And most people that have that large portfolio aren't working 4,000 hours a year. So, but if your real estate's your main activity, it's going to be activities related to real estate greater than 750 hours, and with the proper grouping election. And that election generally is going to have to be updated year over year for additional properties that are added to the portfolio. So Sylvia, I hope that answered your question. And then there's a reference to the YouTube. Definitely check that out. A lot of great videos on there.
So sorry, I was talking, I was muted. So you can go to my YouTube channel. You can either go YouTube channel Mark Maupin or YouTube channel Ralph Maupin. And there's a section on the YouTube channel that says live. So this is actually live streaming there. Then tomorrow I'll download everything and put it on the regular YouTube channel. So you'll be able to rewatch this on that channel. So, feel free to do that. Another question.
So can real estate professional deduct cost segregation on passive income as well as active W-2 income? So if I'm getting a W-2 from my property management company that I own and I qualify as a real estate professional, generally those real estate losses generated by that depreciation are going to offset that W-2 income. It would really depend. If I'm a W-2 because I'm a doctor, I'm generally not going to qualify as a real estate professional. Now, a husband and wife that are married, let's say that the husband is a doctor. He has substantial W-2 income. The wife is a real estate professional. Her situation, she has income from her rentals, has a substantial portfolio, generated large depreciation from the cost segregation. That would come through and offset her doctor husband's income, because one spouse can be active in a W-2. If one spouse qualifies as a real estate professional, they both can take that benefit. So that question, I hope I'm reading it correctly, but it kind of depends. So in the situation, if I'm a doctor and I have a substantial W-2 and I have substantial depreciation from cost segregation, I'm generally not going to be able to offset those if I'm single. If I'm a doctor and my wife has that depreciation because she's a real estate professional, we're going to be able to generally net those together. Again, it's a little bit more deeper than that, and everybody's situation is different. I'd say explore that with your advisor, or feel free to give me a call. We can talk a little bit further, but it's really going to depend on who the actual W-2 is, and is it related to a real estate business that I own, or the doctor example that I just gave. And then I'm not sure. This says half of 750 hours plus greatest activity without net.
Earlier that popped up when you were talking.
Oh,
so it might.
So yes, it needs to be 750 hours and my greatest activity. So the married couple that I gave the example, husband has a W-2 or the wife does. The other one, it has to be their main activity. So and greater than 750 hours. And then, is there a version of 1031 for vehicles? There used to be 1031 applied to any like-kind property. So up until the end of 2017, technically, when you traded in an automobile, most people were doing like-kind exchanges and really never knew about it. I don't know that every business trade-in was treated as a like-kind exchange for vehicles that were carried on the books, but technically those were like-kind exchanges, because what happened was I gave the dealership my car, handed them my title, they gave me a new car, and I either paid cash or signed a loan for the difference. So I never received proceeds, and I stepped into a new vehicle. From an automobile standpoint, that didn't necessarily have the best situation because there's auto depreciation limits, but they totally did away with that. They eliminated all like-kind exchanges, 1031s, with the 2017 Tax Act, and then at the last minute threw in that they still apply to real estate. And I don't believe that they'll really ever get rid of them in real estate, but they got rid of them for everything else. Another question, what's the best way to track your mileage? I have a lot of clients that there's some different apps out there. Those of you that use maybe QuickBooks Self-Employed, or some of the different versions of QuickBooks, they have a mileage tracker. There are some different apps out there that are mileage specific. And then a lot of times it'll just log where you're going when you're sitting there. It'll show you your different trips. You can identify personal or business, and then from business a little bit more detail. If you put personal, it doesn't have to put any more details. So that's a great app. Those of you that don't mind your location showing, at least only to you, Google actually has a great feature, and within your Google Map settings on your phone, if you turn on, I think it's timeline history or location tracking, it'll actually show you wherever your phone's been. So those of you that are going back more manually creating things, it's a good way at the end of the week or end of the month, you can look back and at least see your travels, and it'll give you a mileage. Now, at least I know on Saturday I went to that rental house and it showed that I was driving 38 miles. I can write that down and log that today. Friday, it showed I drove 150 miles, and those 2 trips were personal. This one was business. It would help you just at least gather that. It's not public record, but Google has it, and use it as you will. But I've told people about that. I have some people that use it and love it. Other ones refuse to turn it on because of their privacy. So, but those are different things that are out there. And then the question as far as how to get in touch with me goes back to, if you text 20 to this number, that's my cell number. You'll get if you text that, you'll get a response back that that'll take you to my scheduler, and then we can set something up and talk further from there. Yes. So hours driving to properties, looking at properties, evaluating deals, managing my properties are all going to count toward real estate professional hours. You're active in the real estate business. I would say you could spend 1,000 hours evaluating deals, and then at the end on December 1st, I buy my first deal, and I get 1 month of rent, and I depreciate some stuff. That's not going to qualify as a real estate professional. You really have to be in the business. So again, it's going to be looking at, but pursuing your deals, your hours, you're looking at deals. All those are going to count, but again, it's going to be relative to where you're at already. I mean, I would say somebody who's starting out and between now and the end of the year spends more than 750 hours looking at deals, driving around, and doesn't execute on a deal till December 1st, probably is not going to be able to take that position as real estate professional with one deal. But then that same person, a different person that owns 25 rentals and is looking at many deals this year, those hours are going to count. So then, great question. I think earlier when I talked about cost segregation, I said that used an example of a $3 million property where let's just say it generated $1 million in accelerated items. Effectively, that first year I get that depreciation, but I've lowered my depreciable basis and my overall basis in that property. So that first example, if we don't have a cost segregation, I buy a $3 million property. Let's say I depreciate it down to 2.8, and then I sell it for 3.1. I'm really only going to have a $300,000 gain on that property. My 100,000 appreciation, and then the 200,000 that I depreciated. Now, my example where I said a cost segregation, let's say I took $1 million depreciation and then I sell it for 3.1, I could have a $1.1 million gain. Now that gain in year 2, when I sell it, is going to be different for everybody because investor number 1 may have been limited by passive loss rules. Investor number 2 may have a net operating loss going forward because he's a real estate professional but didn't get to use all of it. And then the other guy, investor number 3, is in other real estate and was able to use that loss last year to offset his other income. And then now this year has a very substantial tax. So again, that's something to plan for. And in those different situations, would a 1031, if you're rolling into a new deal, make sense? Again, it really depends from taxpayer to taxpayer, and that's going to be dictated by the different individuals. My example that an LLC, let's say Mark and I both own that, and we had done a cost segregation or not done a cost segregation. Now we go to sell that property. Our gain would be the same, but how it's going to impact us would be different because our proportionate share would flow through to us individually. So a lot of those items, I always say, tell clients, let me know when you're doing something because we can at least examine the full situation. I had a client last year that sold her large portfolio of single family homes, and we looked at it with some different installment sale options, different purchase or sales price options. And when she was going into the deal, getting ready to accept the offer, had a good handle on what her tax exposure was going to ultimately be and which option she was going to select that they were offering. So a lot of that was driven off of the tax side of things too.
I don't see any more questions that have come in, Frank.
Okay. Okay. Well, hope that helped everybody. And if anyone has any additional questions, you can reach me there, or you can always send an email to tax at reitaxcpa.com and follow up on questions if you have. It's tax at reitaxcpa.com. Just kind of like a helpline, and I'll try to get to those when I can. But appreciate the opportunity to be on here tonight. And thank you, Mark.
Yeah, no, I really appreciate you being on with us. And if anybody has, what I'll do is I will send this video out either tomorrow or the next day to all the meetup groups, and I'll post it on the YouTube. I'll post it on my Facebook groups, and live stream to a lot of that stuff. So it's already up on a lot of them. And I really thank you for coming on, Frank. Appreciate you. And with that, let me see. Hang on. Let me see if there was something else that came on here. Eddie's probably sending me something. Our live meetings for our club will resume the third Tuesday of every month at Kirby's Coney Island in Southfield. It's at 10 Mile and Evergreen. If you check the meetup, you'll see that they always start at 7. And then periodically throughout the month, we have other meetups that we do virtually. So, just watch the meetups for that. So again, I thank everybody being on there. I think Sylvia had one last question. That's a good question.
I don't think so.
That's well, it's a good try.
Yeah.
Okay. All right. So, and the question was, could listening to this count as hours? So, well, with that said, I'm gonna end the meeting. I'm getting a bunch of thank yous, so appreciate you, Frank. And I'm going to end the broadcast, everybody.